What if I told you that these three stocks might have the potential to make you millions? It may sound unlikely, but we're going to break them down and analyze their true value so you can see the opportunity for yourself. The first stock has fallen a lot recently, but has bounced back a little over the past few days. The stock is Alimentation Couche-Tard, a Canadian multinational corporation that operates and licenses convenience stores across North America, Europe, and Asia. Founded in 1980 and headquartered in Laval, Canada, it employs approximately 149,000 people. The company operates under various brand names, including Circle K, Couche-Tard, Holiday, Ingo, and Max. Its stores offer a wide range of products such as tobacco and nicotine products, groceries, snacks, beverages, fresh foods, and road transportation fuels, including electric vehicle charging solutions. So, how can such a boring company make us millions? Well, the reason I chose this company is because of its boring business model. It can easily be overlooked by investors. But how can it deliver strong results, potentially turning $10,000 into 1 million over the next 10 years? To figure this out, we have to look into its moat, financials, and growth opportunities. First, the moat. How big is it and is it significant? ACD's moat is primarily driven by its large scale operations and extensive global network. With thousands of convenience stores across North America, Europe, and other regions, its vast reach gives it strong negotiation power with suppliers and distributors, allowing for more favorable terms and lower costs. The company also benefits from strong brand recognition and customer loyalty. For example, the Circle K brand is well known, particularly in North America and Europe. This recognition fosters customer loyalty, which is crucial for driving repeat business, especially in the convenience store segment, where customers tend to return to familiar locations. Furthermore, there is a moderate barrier to entry in the convenience store industry, particularly given ACD's large network and established supplier relationships. While new competitors can enter the market, they would face significant challenges in achieving the scale and logistical efficiency that ACD has built over time. So, if I were to give ACD's mode a rating, with 1 being an extremely weak mode and 10 being on par with companies like Coca-Cola and ASML, I would give it a 7 out of 10. This is a solid rating as it indicates that the company is likely to be around for a long time, which is crucial for long term growth. Next, does the company have growth ahead? This is crucial because if there's no growth in the future, we can likely expect the same for the share price. The first factor that could drive ACD's growth is its geographical reach. While ACD has already established a strong presence in North America and Europe, there are significant opportunities for further expansion in emerging markets, particularly in Asia and Latin America. These regions have growing middle class populations and increasing demand for convenience stores, presenting a major growth opportunity for ATD. Additionally, the company has a history of acquiring smaller convenience store operators. Continued strategic acquisitions of regional players could help ATD expand its footprint and gain market share in new territories. Furthermore, the company has made a significant shift towards the electric vehicle EV market, which was a very smart move. As people need to spend about 20 minutes charging their cars, they're likely to want a snack or something to eat while they wait. This is great for ACD as it means people will buy more from their convenience stores. Expanding digital services for ordering and delivering also meets the rising demand for convenience, and improving loyalty programs could significantly increase customer spending. Lastly, the company is considering acquiring 7 I, the parent company of 7-Eleven. This acquisition would help ACD expand into Asia and strengthen its presence in North America. The deal would increase ACD's store count, improve supply chain efficiency, and enhance its food offerings. 7-I digital tools such as mobile apps would also improve ACD's technology. Overall, the acquisition would provide ACD with more market power, stronger brand recognition, and greater global reach, significantly boosting its growth potential. However, the likelihood of the acquisition depends on regulatory approval and how well ACD can integrate 7&i, especially with cultural differences. That said, ACD has experience with cross-border acquisitions and a strong financial position, making a deal feasible. If successful, it could serve as a major growth driver for ACD. Finally, how good are the numbers for ACD? The company is fairly large with a market cap of 66 billion Canadian dollars, which is roughly 46 billion US dollars. Looking at its valuation, ACD has a forward price earnings ratio of 16.5 and a price to free cash flow ratio of 18.8, which are decent compared to the industry's median price earnings ratio of 15 to 25. However, it's important to note that ATD is probably better than 90% of their competitors within the industry, so it does trade at a relatively low multiple. That said, this is not compared to its 5-year median of 16.9, which is a bit disappointing. When it comes to the company's margins, it has a gross margin of 17.5%, a profit margin of 3.5%, and a free cash flow margin of 3.4%. While these figures are low, they are normal for the retail space. On a more positive note, AZD has a very high 5-year average return on investment capital of 13%. This next company is one I personally own in my portfolio, and it could become a multi-hundred billion dollar company. Uber. For those of you who don't know, Uber is a delivery platform where you can get rides, deliveries, and more. But to fully understand the potential of this company, we need to go through the same process with Kushitad. Starting with the mode, Uber's mode is built on its large user base. There's essentially no competitor of Uber's scale, with 171 million monthly active users and operations in over 95 countries. This leaves competitors like Lyft with 24.4 million monthly active users far behind, demonstrating how Uber dominates the ride hailing market. Furthermore, Uber's brand recognition strengthens its moat. The first thing people think of when ordering a ride is Uber, as it has essentially become a verb, to Uber something. Lastly, the company's dynamic price algorithms, mapping data, and AI powered route optimization give it a major edge in efficiency. Real time data helps reduce wait times and maximize driver earnings, keeping both riders and drivers engaged. When it comes to growth opportunities, Uber shines. The company is operating within the autonomous vehicle AV space, which is projected to grow significantly and revolutionize how we get around during our work days. However, some people are concerned that AVs could disrupt Uber's freeway business model involving drivers, riders, and Uber itself. If drivers are removed from the equation, only riders and Uber will remain. If AV manufacturers decide to bypass Uber and go directly to consumers, it could hurt Uber. But why would these large companies do this? Beyond the extra profit, Uber's massive user base provides AV manufacturers with immediate access to millions of customers, rather than needing to build their own platform from scratch and handle all the associated costs. Additionally, it's likely to take a long time before AVs fully take over, as they are currently only regulated in 3 countries. They may also not be capable of driving on all the roads, which means Uber could still benefit within this sector for years to come. In addition to this, Uber can grow by expanding into more delivery sectors and continuing to grow its current businesses. This is already happening as nearly every sector Uber operates in is seeing double digit growth. When it comes to the financials for Uber, they have a price earnings ratio of 16.6 and a price to free cash flow ratio of 23, which is relatively low in my opinion, considering the growth potential of the business and the fact that it grew free cash flow by 100% last quarter. The company also has a gross margin of 33%, which is a bit skewed as it has a higher gross margin when considering costs. Uber's profit margin is 22.5% and its free cash flow margin is 15.7%, which are very impressive numbers. Lastly, the company has a return on investment capital of 18%, which is again very strong. When it comes to the discounted cash flow model, I'll use a 9.1% discount rate, a 15% growth rate, which I consider conservative, and a 20% margin of safety. Even with that, the company still appears undervalued at its current price. To conclude, I believe Uber is capable of achieving around 15 to 22% year over year gains, which would turn $10,000 into anywhere between $40 to $73,000 in 2035. The last company is a giant, which still seems undervalued, especially after the recent downfall. It has made people millionaires in the past, and that stock is Amazon. I don't really think I need to explain what Amazon is, but where I see growth for the company is in AI, or more specifically, the cloud space. Amazon owns Amazon Web Services, AWS, which is by far the largest company in the cloud market. And that's great for Amazon since the cloud market is still growing at double digits year over year. Though competition has increased significantly, Amazon is still holding strong with a 19% increase in revenue year over year. What I find particularly interesting is that its advertising business grew 18% year over year, which is another very impressive factor. When it comes to the mode, Amazon stands out. It has an enormous moat based on its vast logistics network, massive scale, deep customer data, strong brand loyalty, Prime membership ecosystem, dominance in cloud computing AWS, and an ever expanding advertising business. These factors create significant barriers to entry for competitors, reinforcing Amazon's leadership across multiple industries. Last but not least, the company has very strong financials. Those ratios are a bit expensive, with a PE ratio of 35 and a price to free cash flow ratio of 63. However, this is a bit skewed due to their large spending on capital expenditures. So we're going to look at price to operating cash flow, which is relatively low at around 18, making it cheap in my opinion, given that you're getting Amazon. The company also has great margins with a gross margin of 48.9%, a 9.3% profit margin, and a 5.2% free cash flow margin, which is pretty good. Lastly, the company has a 5-year average return on investment capital of 8.4%, which is decent. Finally, we're not going to use the discounted cash flow model because it is a bit skewed due to heavy investments. However, I do think this company can deliver a 14 to 18% CAGR in stock price, which would turn into $37 to $52,000 over the next 10 years. Thank you so much for watching. Now, if you want to know how I managed to pick these kind of stocks, watch this video right here.